Well, thank you so much, ladies and gentlemen, for inviting me today. It's a great pleasure to be here. I've been with Sarasin for just over 34 years. I got my first fund to manage in 1988, about 30 years ago, almost exactly. That's me, a fresh-faced, eager young fund manager, rather than the middle-aged version you see, or slightly older on the far right. I've done 9 what I'd call disasters or wars. I've done 5 crashes in one form or another. And through the main balance fund of the firm, which I've either managed myself or been CIO for, we've produced some not bad returns. What I'm most proud about is that grey line is UK inflation plus 4%. So if you'd been invested with us over this time period, you could have afforded to draw 4% a year out of your investment product and still be left in real terms with the same amount of money or fractionally more. And I'll explain why this is important as we go forwards. Out of interest, just while this chart is up, what was my worst crash? Well, I found 94 the worst. I don't know if you remember it. Equities actually ended the year flat, but there was the most ghastly fall in UK gilts. There was a scare of excess bond supply in the inventories of some of the merchant banks around London, and there was a huge gilt sell-off. A 10-year gilt fell 16% at the worst point. Now, why was that such a nightmare? Because rather like today, but perhaps in a less structured way, the lower risk the product you were distributing to the client, the more the regulator encouraged you to invest in bonds, and the more, in particular, they encouraged you to invest in government bonds. So your relatively high-risk accounts were hardly down for the year, and your low-risk accounts were down in, mid-double-digit figures. So all the risk numbers were upside down. I'll come again to why that's relevant today, but remember, as I speak this morning, a UK 10-year gilt yields you just 0.8%. Who do I manage money for? Well, about 25% of the 14 billion I look after is for people like yourselves, but the largest portion, about 50%, is for UK charities. We're one of the top 3 charity managers. Hospitals, churches, universities, research, dogs, cats, nurses, food banks, housing associations. Now, you might say, well, why is that relevant to us today? Well, I hope to show you, and I hope to take some lessons from the charity sector and take them over to the pension and retirement sector. Now, I'm straying out of fund management world much more into your world, but as I understand it, pre-George Osborne's 2014 budget, the basic centralised investment proposition for pensions and retirements was a save and accumulate phase and a withdraw phase, which ended post-75 or in an annuity of some sort, which basically took you back to zero where you began again. Post-2014, the line moves flatter, and there is an incentive to maintain the value of that pension, and as I understand, inheritance tax is particularly favourable in passing that asset on. So having been the first asset you ran down, it now almost becomes the last asset you run down. This has very close parallels to charities. If you take St Bart's round the corner, we look after part of their charity their charity fund, which is to top up some nursing and research departments. They need that income at a rate that grows above UK inflation year in, year out, but they would like to pass it on to the doctors and nurses who work there now and future generations. So they want to draw down today. They want to match inflation, but they want that line to be somewhere near horizontal, which is, in my understanding, what a lot of your clients and James Hayes' clients now want. How do they go about doing this? Well, what I'm going to show you is the asset allocation of a typical hospital or charity, 25, 10 years, and now. So 25 years ago, it was pretty traditional. There was about 35% in global equities, 20 in UK equities, a big slug of bonds, some international bonds, because currencies were moving around, and a little bit of cash. 10 years ago, you see the equity content has lifted a little bit because bond yields are coming down. The global content has climbed. The international bond content has fallen, and the gilt content has fallen really quite substantially. Take that forward to today, and the big increase has been into global equities. Now, why is that? Well, partly because it's a strong returning asset class, it's well diversified, and you heard from T. Rowe Price some incredible active opportunities. But I would argue the other thing that has happened is the growth of global dividends. If you wanted this recurring income, you were 10, 15 years ago really constrained to the high yield markets, and particularly the UK market. But our disciplined, progressive dividend culture in the UK has gone global. And we saw an incredible crop of dividends this year, but the fastest growers were in Asia and in the US. So if you run those numbers back 50, 30, 20, 10 years ago, you can calculate what amount could you draw or your client draw from those asset allocations and still leave the pension pot over a 5 or 10 year period equal in terms of real value. Over 50 years, you saw a big drawdown in the 70s, but you made a lot of that back in the 80s and 90s. And over the 50-year period, you could have afforded to draw down really quite a large number, nearly 5%, and still be there with real assets. 30, the number's about the same. 20 years, you hit a number of quite large crashes. You hit the tech crash of 99, 2002, you hit 2008, and you hit the Eurozone crisis, which weighed quite heavily on those returns. The last 10 years, thanks to QE, assets have risen, and you're back up again at around about 3.7%. So a sort of number round about 4% is what our charities assume they can draw down and still have a reasonable chance of preserving overall capital. By the way, in those figures, I've assumed a cost, and I don't know if I'm right, of an average fund manager of about 65 basis points in those calculations. So we've seen the picture in the past. What's the position going forward? Well, I'm afraid we've got a number of problems about achieving this going forwards. The first problem is the very obvious one, that bond yields and interest rates have collapsed. When I started running the balance fund, I showed you UK interest rates were 15% and UK 10-year bonds were yielding 12%. Today, UK interest rates are 0.75% and UK 10-year gilts are 0.8%. If you thought that was bad, look at the 5-year bond market, and the following countries ask you to pay to lend them money for 5 years. France, Germany, Spain, Portugal, Sweden, the Netherlands, Switzerland, Ireland, and Japan. In all those countries, if you say, will you take my money for 5 years? They say, yes, I will, but you've got to pay us, on average, about 30 basis points a year. The German 10-year has reached an all-time low last week, all-time low ever seen, of minus 0.2%. So if you lend Mrs. Merkel money for a decade, she'll charge you 20 basis points a year. She put a bond out, or the German government put a bond out last week, about just under 10-year bond, yielding about minus 0.15. They asked for about 1.8 billion euros. They got bids of 5 billion. They were 3 times oversubscribed for a guaranteed 10-year, year-on-year loss of your money. So that is the extraordinary situation. You might say, well, how is this even possible? I think in the Eurozone, one must assume that the Italian debt burden might ultimately cause a split in the currency. If a split in the currency occurs, where do you want to be? You want to be in Germany. So what you might lose today, you may make tomorrow. But it is an extraordinary concept. I start with 15% when I begin my career. I end up with minus 0.2%. So the Japanification, if you like, of Europe is happening in front of us. That means for all of you who are trying to achieve inflation plus recurring income for the new centralized retirement proposition, most of the bond markets are off limits. In fact, 13 trillion of fixed income securities have a negative yield. Now, you're trying to get inflation plus 3 or 4. They're giving you a negative actual nominal yield. The second problem is that you'd think if debt was very low, yields were very low and prices were very high, there wasn't much of it. Well, unfortunately, since the financial crisis, debt has ballooned in every region. But we had, at least at the government level, started to pay the numbers down, and the numbers were improving. That was, of course, before Donald Trump. His tax cuts are so large that over the last 12 months, his expenditure is up 26%, and his tax receipts, even in a booming US economy, are up 4.7%. So the US deficit is exploding on an upward channel. This is the front page of the Congressional Budget Office US Budget Monitor, and you can see that on current trajectories under Trump, by the mid-2030s, we exceed the peak achieved during wartime. He's doing something that no president has ever done before. He is throwing on a lot of tax fuel onto the economy after a very strong growth phase. In another 2 months, this will be the longest US recovery, the longest US economic recovery ever since the Second World War. Normally, you start to be pulling debt back. Trump is putting debt in. In fact, if he keeps at his current spending rate, he will spend in tax cuts the entire British national debt between now and his re-election, or not, in 2020. So your second problem is yields are very low, and there is a possibility of an absolute tsunami of new debt appearing. So third thing, you say, well, I've got no yield, there's too much of the debt around. Well, could I take some debt risk and go and try and improve that yield? Now, all of you have bought corporate bond funds in your time. The problem is the quality of debt is falling. This was one of the big warning charts from the IMF's quarterly report that came out a few weeks ago. The green is US BBB rated bonds, and the red is European BBB rated bonds. The two layers, one on top of each other, are the totals. Those lines are the percentage of issuance that they account for. So if you look to the left, those two lines are about 50%. In other words, 50% of everything issued was BBB rated or below. If we'd been sitting here before the Charities Act in 2002, no charity would have been able to buy that. In fact, when I joined the market, we didn't buy anything below AA. So the quality of debt is continually falling. Just for example, we're going to have big downgrades this year for General Electric. That was an absolute staple of pension portfolios. We're probably going to have a downgrade of UTX on their recent acquisition of Raytheon, another staple. We're probably going to have a debt downgrade of Rolls-Royce. And you've seen the pressure that this puts on bond managers. We saw what happened at GAM, where, for many good reasons, they went for unlisted debt to try to escape some of this and got into liquidity problems, which are unfortunately familiar elsewhere in the last few weeks and days. So what's the answer? One anomaly seems to shout out from investment markets today, and that is, although interest rates have fallen, bond yields have fallen, corporate bond yields have fallen, dividend yields are still very attractive. Now, when I started my career, or started investing money, this blue line here is the yield on a British bond minus the yield on a British equity. When I started, a British bond yielded 7.5% more than a British equity. Today, a British equity yields 3.5% more than a British bond. And this is not just a British phenomenon, it's happening in Japan, it's happening in Germany, if you include share buybacks, it's happening in the US. Dividend growth is so strong that it's made up for a lot of compression in yield that is a result of just the price rising. So you have this window to lock in dividend yields. And the consistency and growth of dividends is extraordinary. We've put in dividend increases twice inflation, year on year, for the past decade that I've been managing our global dividend fund. So first of all, if you're going back to your desks and thinking, well, if I've got a retirement client who's wanting to pass on some of this capital, well, he's wanting to draw down, could I use global dividends? What are the rules of the game? Well, first of all, I would beg you to go global, not local. While there is a role for UK income funds, there are terrific distortions in our market. 45% of all FTSE 100 income comes from just 5 stocks. You probably all remember the nightmare of 2011, BP Macondo. In one night, 11% of British dividends went up in smoke. It was the largest at that point contribution to the British dividend part in one single company. If you'd had 11% in a single company in capital terms, of course you'd have broken UCITS and unit trust rules, but that's the concentration there is in dividend. 62% of all income comes from the top 10 companies and 79% from the top 20 companies. Particularly with changes in technology, particularly with changes in ESG and climate, which can threaten long-term dividend growth, I just wouldn't advise you to have this sort of concentration in a retirement portfolio that's got to pump out that income for 10, 20, 30 years. The second problem is quite a lot of the UK market has relatively fragile dividend cover. That's the amount of profit delivered each year by the company relative to the size of the dividend. If that cover is low, they haven't got much buffer if profits fall. Now, the bubbles are the size of the companies. The x-axis is the yield from 8% here down to 0, and the y-axis is the cover. So the higher up that cover, the safer you are. Now, you can see over 6% in the UK, this crop of problem companies. There's Vodafone, cut by 40% last week, its dividend, an absolute staple of UK income portfolios. Marks and Spencer's I haven't got on here, cut by 26%. And we're on risk for British American Tobacco, for Imperial Brands, for EasyJet, for Centrica, the list goes on and on. Globally, I would much rather sit down at the 3 to 4% level, this is the yield on global equities, and sit somewhere there. The second problem with the UK is the sector split. We have a very large proportion in energy and materials. Now, while the biggest dividend in the world last year came from BHP, the mining company, that was a special because they disposed of their oil interests and passed those out to investors. But do we really know whether the Royal Dutch dividend, whether the Rio's dividend, whether the Glencore dividend is safe in a Paris climate world? I don't know the answer. And that is 25% of the UK market and almost 40% of the underlying dividends. So this is the split by sector of the FTSE 100, and that's the split globally. So I would say global for a pension stands out. One thing to bear in mind if you go global is the question that was fired to the previous speaker about should you hedge the currency. Because of course, if you go global, you're picking up quite a lot of currency risk. And you could say, well, I get currency risk in the FTSE 100 anyway, because 69% of FTSE 100 earnings are international, but you get direct currency risk. And of course, after the great fall in sterling through this Brexit drama, actually there's a possibility sterling could rebound. I think that's quite a real possibility. Just 30 seconds on Brexit. All I would note is that if you peel Brexit away, Britain PLC doesn't look too bad. That's the deficit, peaking at an appalling 10% of GDP in the eve of the crisis, got down by Osborne and Hammond to 1% today and falling. If Boris doesn't get his giveaway, it's possible that Hammond goes into surplus, just possible. Secondly, the unemployment rate, you all know numbers, 3.8%, a 44-year low. Some incredible numbers, the largest number of women ever employed in British history. And if you take job openings and match them to the unemployed, if you allow for 300,000 or 400,000 people moving in between jobs, the unemployed pool and the job openings pool are almost equal. In fact, in technical terms, you have zero unemployment. Finally, of course, the inflation rate is remarkably well behaved with the sterling collapsing. We've only got a 2.1% headline rate and under 2% core rate. So peel those away, the numbers look quite good. So if there was to be a deal, if we were to ink something with the EU, my hunch is there's an enormous relief rally. And if you look at sterling dollar, we're back at very, very close to all-time lows. We're just a whisker off the level we were on the eve that the Royal Bank of Scotland cash machines almost closed in 2008, and the world is a very different place. So for my charities, I say at this point have 50% hedged and 50% unhedged. 50% in a sterling hedged version and 50% in a sterling unhedged version. Now, you might say, well, I would say this because we're one of the few houses that have both. But we have both, and at this point, I would take a little bit of currency protection just because the numbers are so low. One other point, the quarterly results came out from the Bank of America Merrill Lynch Fund Manager Survey, which is the biggest in the world. And they asked the world's fund managers, what assets do you like most and what do you dislike most? And of course, as you could probably guess, the ones they dislike go up and the ones they like go down. But for the fourth quarter in a row, the thing they've disliked most is the problem EM economies, South Africa, Turkey, Argentina. The second most disliked asset on the planet is everything British. There is an enormous bias away from any British asset because of political uncertainty. My hunch is, was that to change, does the money come back and perhaps the patient gets up and walks? Then all those lovely FX gains you made in all your global funds you're holding for your clients suddenly don't look so smart. So be a little bit cute about currency hedging. It's cheap and easy to do. Buy 50% of the hedge fund, 50% of the unhedged. So with all these challenges, if I'm looking at 10, 20 years, where are your clients going to get that dividend growth that's going to give them that 4% drawdown ahead of inflation? Well, I've got just a few ideas. Firstly, we are a thematic investor. We try to back some long-term trends. Climate change, automation, evolving consumption, digitalization, and aging. And we think very much like you heard from T. Rowe Price with much greater expertise in some of those areas which we think will generate long-term alpha. I'm going to focus just on two. Climate change. I think we're rapidly moving from a climate risk to a climate opportunity. This has just come out from the Bank of England, BP, and McKinsey's, and it's a long-term energy forecast, and their guess is the world needs about 30% more energy over the next 20 years. Not for us, we're consuming, yes, principally for electricity demand in Africa. Remember that Nigeria will have a larger population than the United States of America by 2050. So it's primarily African demand. But we've got to do this with 35% less carbon if we've got a chance of meeting Paris. McKinsey's reckon you're going to need about 75% of GDP by 2030 to do this. Now, that's a number plucked out of the air, but you can see the scale. If they're right, it's the biggest investment opportunity since World War II. And rather than thinking of the problem, I'm focusing my portfolio to low-carbon transport, to water and waste, to infrastructure, to food technology, to look at zero-carbon fuels, to look at smart buildings. The list goes on and on. So I think as we pivot, this is going to change. There's going to be an opportunity even to buy back into the car stocks. So climate change, number one. The second thing that gets me very excited about potential dividend flows, I've just been down to Airbus to one of their factories, and this is a sort of mock-up. Most factories I go and see now have a 3D printer in the corner. Pretty well all of them have predictive maintenance, telling you what to service and what to change. Most of the parts are traceable directly. They'll all be linked with their own IP address to the Internet of Things. It's happening very, very fast. Most of the warehouses are automated. The list goes on and on. So automation and digitization, bringing big data in the cloud down to everyday production processes, I think is going to be an enormous boom as the factory changes. Schneider, TSMC, Texas Instruments, the list of potential beneficiaries go on. So climate, automation, digitization are areas where, without paying excessive multiples and where dividend yields are attractive and growing, you can build that income stream for your pension retirees 10, 20 years out from now. The final thing you've got to do, number one, go global. Number two, protect your currency. Number three, look for the long-term drivers. The final thing to you is you've got to watch ESG, environmental, social, and governance. This isn't just a nice to have and a whitewash. If you look at the dividend disasters, they're normally caused by an ESG problem. If you look by the banks, a governance problem. Take another example. Nissan Motor was a classic dividend stock. It was very high yielding by Japanese terms, just under 3%. It was in all the right places, electric cars, technology, etc., and it had a dynamic and compelling CEO, Carlos Ghosn. If you looked at the holding company, as our ESG team did, they spotted one thing: there were no controls. At the Renault-Nissan holding company at the top, there was no remuneration committee, no appointments committee, and only one NED, and he didn't even come from the car industry. So as we now know, Carlos was a brilliant guy, but he was running in governance terms almost unconstrained, and the rest, as you can say, is history. So I'm convinced that failure in one of these areas is going to be the principal area that will damage your dividend growth. It's very real at the moment in the energy industry. How much can we trust the Shell dividend going forwards? The questions come up. We looked at the coal industry. That was a big dividend payer. So ESG is extremely important. So buy a fund that either has a very strong awareness or has a sustainability overlay. That's some of the companies that we are working with or have avoided. So to wrap it up, what do we at Sarasin do about it? Well, we have two funds. We have a high dividend fund, which I manage, which is deliberately boring. It's a bond fund dressed up as an equity fund. It's got low volatility, low cyclicality businesses, very high ESG score, and its real goal is to bring in a 50% yield premium to the MSCI index, about 3.5–4%, year on year on year. It's designed to go up a bit less than the markets when there's a bull run and down rather less in a drawdown. So it's really doing the role that a corporate bond fund would have done a decade ago. And that's my job. I do that for charities, and I do that with a hedged and unhedged version. Our numbers are good. We've compounded at about 11% over the last 5 years, which is only a fraction short of the overall market. But I'm particularly proud with his dividend growth. Year in, year out, I'm getting double inflation, which is critical to your retirees. My colleague Jerry Thomas runs the more traditional fund. That is just a 15% premium to the index, so about 3%, but that goes for stronger dividend growth, and you'll see the returns are 1% or so higher because it's more growth orientated. It'll come down a little harder in a correction, but if you're looking at 10 or 20 years, that will have very strong dividend growth. So I hope that's helpful to you. Just to recap, I think pensions and charities are closer than you think, and I think this endowment approach is really valuable for the modern retirement plan. Bonds are a real problem. You've got to work around them. Dividends seem to be the solution, but go global, hedge, and be careful with your ESG. Thank you.
Guy, we do have a couple of questions, so allowing for time. Do you want to pick one if you could answer?
If it comes to the UK pay out high dividends rather than reinvesting profits, how does it affect their growth and the total economic growth in the UK in the long term? Well, that's the bubble chart for you. If you're paying out high dividends and your underlying business isn't growing and you're not reinvesting, you've got a problem. And that just, unfortunately, because of history, affects a large part of the UK market. In earlier years, the big exposure to oils and mining was a huge positive for underlying dividend growth, but it's more of a challenge today. How much debt can the US afford before it comes too much? That is probably the hottest question in central banking today. Trump and some really bright East Coast economists think we should be turning things on its head. After all, we asked this question of Japan 25 years ago, and they spent and spent and spent, and what's happened, yields have gone down, not up. And there is a broader question being asked by a lot of populist politicians. If interest rates are close to zero today and the government can borrow at close to zero, why doesn't it borrow as much as it can to do productive things? It's a little bit in the Corbyn People's QE. It's a little what you're hearing from Salvino and Di Maio in Italy about issuing bonds to pay government arrears. You'll certainly hear it with Trump philosophy, and this is going to be a huge issue going forward. The sort of catch-all phrase to look out for that covers all this is MMT, modern monetary theory. A lot of people think it's bunkum, but I think we're at a real tipping point. My worry is if you do go down this route and the economists are wrong, it could be extremely painful for bondholders, which is another reason I'd rather be in the dividend. Have we time for?
You can do one more, yep.
What happens to pension payments in another crisis? It's quite easy to, if you take a dividend fund, it's quite easy to ask the manager for some characteristics on the overall fund. You want to look at dividend cover. You want to look that debt levels are not too high. You want to look core return on equity is good. And you want to be absolutely eagle-eyed on ESG. And if you're right, history shows that these dividends survive very well in a sharp drawdown. If you look at a Nestlé, if you look at an Novartis, if you look at a Unilever, they didn't miss a beat in the 08-09 crisis. But, of course, in a go-go market, that will mean that you'll be holding some relatively, in inverted commas, dull stocks. So it might be that you underperform. So there is a price to real income consistency. But the quest for absolute income, of trying to get an income that goes up every year, I think is realistic from some of these global companies. And of course, the UK's got a relatively high payout ratio. If you take Japan, the average Japanese company only pays out 26% of its profits in dividend. If Japan played out the same rate as the UK, the Nikkei will yield nearly 7%. So there's a lot of potential to buy very conservative income flows if you're prepared to go global. So it's a good question. Just finally, when and how will US debt be repaid? The traditional way is to inflate it away. There are very few examples of governments being strong enough to pay it down. That is an exception in Germany, and to an extent, I think, an exception of I think, quite an underrated chancellor. I think George Osborne will be written pretty well up. I think that transformation, the deficit, is remarkable, but it's tough to do. The academics are scratching their heads because Japan by now was meant to have gone hopelessly over the cliff in terms of debt accumulation. Exactly the reverse has happened. So this goes back to MMT and is, I think, one of the big economic questions of our time. Good. Well, thank you very much.